Okay, hi everyone. Thank you very much, Jess, Walter, and Chris. Can you hear me okay? Sorry, I was muted for a bit.
Yes, we hear you.
Okay, great. So thanks very much for this invitation. Very hard to follow Eric, but I'll do my best. So before I talk about hybrid prediction markets, I'd like to start by just talking about classical or traditional prediction markets, which have been around for about 30 years or so. And these are just modeled on standard stock markets or futures and options markets for the trading of more traditional financial securities. The only difference really is the types of contracts that are traded over here. And these are state contingent securities, sometimes called binary options or event futures. And the idea is basically that you buy a contract and it references an underlying event. And if the event occurs, you get paid a fixed amount. And if it doesn't occur, you get paid nothing. So they're very risky contracts. But they trade in exactly the same way as stocks trade on an electronic exchange. Basically, the process is referred to as a continuous double auction. People submit orders that specify both the price and quantity. These orders will either trade if they are consistent with something that came before and is still waiting, or they will enter into an order book and wait for subsequent orders to come and trade against them. And the idea of the prediction market is to harness the wisdom of crowds and quickly aggregate distributed information. And it's believed that this would generate better forecasts than alternative approaches. And there's some evidence to support this. But so let's take a look at what predicted. So this is the main sort of legally operating market in the United States at the moment. Many of you will be familiar with it. So these are, this map just basically reflects the prices on 50 different markets, one for each state. And the colors tell you who's ahead in terms of which price, whether it's the Democratic or the Republican nominee's price is above 50 cents to the dollar. And the shading or the color intensity tells you by how much. So you can see that the lighter shaded states are close, and you can see how they're split. And I'll come back to what this map is telling us in a bit. So suppose if you look at Wisconsin, this is from a couple of days ago, but the prices are about the same today. Suppose you believe that the Democratic candidate would win Wisconsin with 70 or 75% chance. Well, in that case, you might want to buy a contract, which is available right here. You can see on this slide for 66 cents. And that'll terminate, that'll give you a payoff of $1 if the event actually occurs. So if you buy 100 shares on Wisconsin, Democrats to win Wisconsin at 66, that will pay off with $1 if that happens, and you lose your 66 cents otherwise. Now, with predicted, you're going to have to pay a fee, a 10% fee on the profits. You don't pay anything if you lose. And that's going to distort this market in a way that I'll describe in just a second. So if you look at the market, for the overall outcome, who's going to actually win the presidency, you see that the market is predicting a roughly 60-40 outcome, at least in terms of the probabilities, if you interpret the prices as probabilities. Now, a problem with interpreting these prices as probabilities is that that fee structure actually distorts the prices, and the sum of the prices can depart quite a bit from 1, which is what you need in order to interpret as probabilities. So I won't go into that, but despite those distortions, roughly speaking, you can say that the market is predicting about a 60-40 election. Okay, what about models? So model-based forecasting takes a completely different approach. You have pre-selected variables. They're estimated using historical data. So in this case, for election forecasting, it would be polls, approval ratings, economic indicators, partisan lean, and so on. There are a whole bunch of such forecasts out there. One of the most interesting ones actually is by The Economist, which I'll go through in just a second. So here's The Economist forecast by the states. Very similar to the predicted forecast. You can compare state by state by just going to this website and comparing it to the predicted website. And the Electoral College prediction is also not that different. But here you see a really big difference. So the bottom line with regard to the election, this is not a 60-40 election according to the Economist model. It's more like an 80-20 election. So why the difference, and which one should we take more seriously? So clearly, these two forecasts are mutually inconsistent. So in thinking about that, let's think about the shortcomings of each of these two approaches and see if we can construct a hybrid approach that can leverage their strengths without falling prey to the shortcomings. So with markets, and this is true with the Iowa electronic markets right now, you can have limited liquidity. They can be thin markets, wide spreads between the buy and sell prices, not much participation for some markets, but that's definitely not true for predicted, where you have millions of contracts traded on a daily basis. There can be incentives for manipulation, and I want to talk about this a bit based on some prior research with David Rothschild, that people may have an incentive to try to manipulate the prediction market prices if they're taken seriously by the public at large, and the reasons for this we'll get to in just a second. I've already talked about the fee structure distortions. Those are relatively minor distortions. Now, there are disadvantages with models also. So with models, you need to identify relevant variables ahead of time. And you are limited to a small set of predictors to avoid overfitting when you're testing with historical data. And of course, there's a lag between the appearance of news and conventional metrics. So for example, if a campaign rally is scheduled, or a governor changes policy, or mask use is made mandatory, these kind of policies are going to show up in data only after a period of time. Markets can react to this much more quickly than the models can, because the models are, will be based on things like opinion polls, which may not reflect these changes for quite some time. So before I get to hybrid prediction markets, let me just talk about some work with David Rothschild that looked at data. This is extraordinarily detailed data from InTrade, which no longer exists, but was very important for the 2008 and 2012 presidential elections in the United States. And we had data on every single transaction for the 2-year period preceding the 2012 election. And we looked at 13 million contracts, about or close to 300,000 transactions, 6,300 unique trader accounts. Now, we don't know who these traders are, but for every transaction, the buyer and the seller, the accounts that are involved in the transaction are tagged. And so we can trace all the transactions associated with a given account over this entire two-year period. And from that, we can sort of construct an ecology of the market. It actually tells us quite a bit on how this particular market, and we think actually more generally financial markets, actually aggregate information. You have a real rich ecology of trading strategies. They interact with each other, and the resulting price is the outcome of this interaction that evolves over time as different accounts get larger and smaller and strategies change and so on. I won't go through this in much detail. I can refer you to the paper if you like, but basically a few small traders dominate this market. So this is in a log scale. Total volume is the number of contracts purchased, and the transactions is the number of trades. And each point here refers to an individual trader. There's 6,300 of them. And a whole bunch of people will just trade once or twice. You can see that on the left, although they may have a large trade. But right up there at the top, you get people who trade very frequently and in large amounts. So this slide contains a lot of information about the top 10 traders, but I just wanted to focus on the top 2 rows, the 2 largest traders who traded 4 million and 2 million contracts roughly, respectively, through 70,000 trades in the case of trader A and almost 23,000 in the case of trader B. And these are completely different strategies that they're adopting. Trader A adopted an algorithmic strategy, and the margin that you see on the column towards the right is the total amount of money that was at risk, the most that this trader ever risked at any point in time. And it's about less than $10,000. The profit made was about over 60,000. Trader B risked $7 million almost and lost the whole lot. And so this person was following a very different strategy. Let me just quickly show you these strategies and I'll get to the hybrid market. So this is what trader A did. So this is algorithmically implemented and basically was betting against Romney and Obama virtually simultaneously whenever the prices reached such a point where you could bet against them both and make a risk-free guaranteed profit, basically an arbitrage strategy. This would be implemented by this trader. And often the time that elapsed between the selling of the Romney and the selling of the Obama was less than 1 millisecond. So they have the exact same timestamp. And this is basically a risk-free strategy, not much risk involved at all, but you make a small amount through 70,000 different trades. And so this trader managed to make money without risk. And this is part of the ecology of a prediction market and more generally a financial market. Here's what the other trader did, and just kept betting on Romney and against Obama over the entire 2-year period, accelerating towards the end. And there's evidence in the paper. It's not decisive, but we suggest that there may be some manipulation involved here in the sense that the trader was trying to put a floor on the price of Romney and a ceiling on the price of Obama. And in election prediction markets, there's a positive feedback effect. Actually, when we posted this, it attracted a fair amount of attention. People were trying to figure out who this was, who lost millions and why they were doing it. But basically, why would you do that, and how can manipulation actually be effective? It's because there's a positive feedback effect in beliefs about elections, what political scientists sometimes call bandwagon effects, where if somebody is believed to have a very low likelihood of success, that can have an effect on fundraising, morale, turnout, and this is why campaigns will often release internal polls that are favorable and suppress ones that are not. Um, and if you can manipulate the market price in such a way that makes people more optimistic about your candidate, that belief can then become self-fulfilling. It can keep a campaign viable, which would otherwise move towards a failure. And the cost of manipulation, even $7 million, is really small compared to the cost of campaigns these days and how much money is spent on even a single primetime ad. But there's a paradox at the heart of prediction markets, which is that the incentive to manipulate only exists if the market is actually taken seriously, and the market will be taken seriously only if it's not manipulated, if it's perceived to be unmanipulated. And so there's a limit to the degree of manipulation, just as there's a limit to forecasting accuracy. It's sort of self-limiting. So that leads to the final question I just want to wrap up with, which can we somehow integrate the model approach and the human judgment approach? And part of what I'll describe right now is funded by a grant from IARPA under the hybrid forecasting competition. And I was part of a team that was led by Ram Galsyan from University of Southern California called SAGE, Synergistic Anticipation of Geopolitical Events. This is a successor to the same IARPA-funded aggregative contingent estimation competition, the ACE competition that was won by the Good Judgment Project you have read or heard about. And the idea was to have hybrid forecasts that combine machine models with human judgment in some way. But there were severe constraints imposed on the development of machine models. They had to be developed before you knew exactly what the questions that they would be used for were disclosed. So the models could not be tailored to specific questions like elections or disease prevalence, and they had a broad scope of preference. And I have to add that all IARPA questions were pertaining only to non-US countries. That's the scope of the grant. So these are sort of examples of questions. Will there be a W2 dispute between country A and country B? Temperature anomaly, cyclones, floods, civilian fatalities and civil conflicts, and so on. And the models have to be constructed before these questions are revealed. They have to just pick out keywords and databases in the questions to try to forecast. So this severely limits the ability to develop effective machine models. And I'll come back to this point in the last minute or two that I have left. So in order to try to create a hybrid forecasting platform, one of the approaches, and I should say the team took many, many different approaches, but one of the approaches was to develop hybrid prediction markets. And I'll describe to you what this looks like without presenting you any results. We are still in the process of testing and thinking about applications. So I'll just give you the design, not any particular performance indicators. So a hybrid prediction market basically is a prediction market in which a model-based forecast is represented by a trading bot that acts as if it believes that forecast, is endowed with risk preferences and a budget. Those preferences can be tuned, and it basically just acts like any other trader. But when the model changes, it changes its beliefs, and therefore it will cancel and replace its orders. So very quickly, just to illustrate, suppose that you have n different bins. So in the case of binary questions, is X going to win or X going to lose an election? There will be only 2 bins. But in principle, you could have 3 or up to 5 bins in some of these questions, where you have bins in which a numerical outcome, such as a gold price, can fall. Suppose the model generates a prediction P star. So this is the probability that the real outcome will lie in bin I, is given by Pi. The bot has a cash position denoted by Y, and asset position denoted by Z, which could be positive or negative. These are the sort of shares held in each particular bin. And the preferences are denoted by a function U of W, which we call a utility function, where W is a random variable denoting the end of period wealth. So when this market resolves, the bot is going to receive some income from all the transactions that have taken place. And this is a random variable, and the probability will determine, the beliefs will determine the expected value. The bot is going to maximize its expected value. So I won't go through the details, but basically you want to try to find the highest price at which you want to buy shares, the lowest price at which you want to sell, and you place the corresponding number of orders at those prices. Very quickly, an example where your beliefs, the machine model is predicting, 30%, 50%, 20% likelihood. On the table below, if you run through this process with a particular set of preferences, cash endowments, and so on, that's my 15 minutes, so I'm going to wrap up. The table below gives you the prices that the bot will post. And this is what the trader would see. So there's an actually constructed market. Whether the approval rate for Japan's cabinet will fall in in each of these three bins. The trader can, buy or sell contracts in each of these three bins. Here's the particular bin, the approval rating being more than 45. You can buy yes or no contracts. This is what the trader sees. This is the counterpart to what the bot has posted. If the trader then trades, that changes the bot asset position and the cash position, and this will cause recomputation, and you'll end up again with revised prices, which are then displayed to traders on that market. So that just speaks to the design, and I'll just wrap up. I know 15 minutes are up, but I'll take 30 seconds to just tell you where we want to go with this, and this is outside the bounds of the IARPA funded project. Because that is too limited in the sense that the machine models that anchor the prediction market are too constrained, too heavily constrained to be designed prior to the knowledge of what you're trying to forecast. If you know what you're trying to forecast, you can construct much better machine models. And the application that we are now working on has to do with COVID prevalence. And there are a bunch of models that are submitted weekly to the CDC, epidemiological models with parameter estimated through incoming data. And they give you wide variation in forecasts across regions. These are hugely important forecasts. And you can think of, campus reopening decisions, travel restrictions, and so on. The models can, they can incorporate a lot of information, but they cannot incorporate novel qualitative information in the way that prediction markets can. For example, if there's a campaign rally scheduled, a high density event, a sporting event scheduled in a particular location, a governor changes their policy with regard to mask use, so on and so forth. These things can be incorporated into market prices well before they actually enter into the underlying data that can be used to adjust the model. And here's a quick example of one of these models, the Yu Yangu's very successful model for COVID prevalence. And you can see he's predicting order of magnitude difference in September, October between New York City on the one hand and LA, Chicago, and Philadelphia on the other. And by filtering this through a hybrid prediction market, the idea is to see whether or not one can improve on the machine model forecast. I'm going to stop there and just acknowledge David Rothschild for the earlier research, Danny Benjamin for the current one, my RAs, Amara Enverigi and Julie Seeger, and Aram Galstian, who was the PI on the IARPA grant. Thank you very much.